Hey everyone! Welcome to our channel. If you're looking to build wealth and make smart investments, you've come to the right place. Today, we're taking a deep dive into Enterprise Products Partners, stock symbol EPD. Enterprise Products Partners is a company that many investors are considering a strong player in the energy sector. But is Enterprise Products Partners, or EPD, really a no-brainer buy right now? In this video, we'll explore EPD's past performance, financial strength, and the company's unique structure as a limited partnership. We'll also break down its dividend, which has attracted a lot of income-focused investors, and discuss its outlook for the future. Before we begin, don't forget to subscribe to our channel and hit the notification bell so that you're the first to know when we release a new video. Enterprise Products Partners has been around for over 60 years, and it has built a reputation as one of the most stable companies in the energy infrastructure sector. With assets across oil, natural gas, and petrochemical pipelines, EPD has diversified its revenue streams, which has helped it stay relatively resilient during energy sector downturns. In the past decade, while many energy companies have faced tough times, EPD has generally outperformed thanks to its focus on fee-based income from its pipelines and storage facilities. This stable cash flow structure has made EPD more resilient than other companies that are more exposed to fluctuations in commodity prices. So, while there have been ups and downs, EPD has held steady, even when oil and gas prices have dropped. Let's talk numbers. Enterprise Products Partners is financially strong, with a solid balance sheet that's built for stability. One of the key things to note is EPD's strong cash flow, which is crucial for covering its operational expenses, debt, and, of course, its dividends. In terms of debt, EPD has maintained a relatively conservative debt-to-equity ratio for an energy infrastructure company. This is a big plus, as lower debt levels mean less risk for investors and more cash flow to reinvest in growth or return to shareholders. EPD's financial discipline has allowed it to consistently weather industry downturns and has enabled the company to maintain its dividend payments through thick and thin. We'll talk more about that dividend in a minute. Now, before we go any further, let's talk about EPD's business structure. Enterprise Products Partners is structured as a limited partnership rather than a traditional corporation. But what does that mean for investors? Well, a limited partnership, or LP, is a type of business structure where there are general partners who manage the company and limited partners who are the shareholders. As a shareholder, you're essentially a limited partner, which means you get a share of the company's profits but don't have the same level of voting rights as you might with a regular corporation. Limited partnerships often come with tax advantages. Instead of paying corporate taxes, an LP's income is passed through to shareholders, who then report it on their personal taxes. This pass-through structure can result in a higher yield for investors, which makes LPs like EPD popular for income-focused portfolios. It's important to be aware of this structure because it also means that EPD's dividends are technically distributions and are taxed differently than regular corporate dividends. Alright, let's talk about that dividend, one of the biggest reasons people invest in EPD. Enterprise Products Partners currently offers an attractive yield, which is significantly higher than what you'd find with most S&P 500 companies. In fact, EPD has one of the most consistent dividend track records in the energy sector. EPD has not only maintained its dividend through downturns but has increased its distribution consistently over the years, a huge draw for income-focused investors. And as we mentioned earlier, because EPD is a limited partnership, this dividend is technically called a distribution. This distribution is largely funded by the company's fee-based income, which provides a steady revenue stream even when commodity prices fluctuate. This reliable income stream and consistent dividend growth make EPD a popular choice for those looking to build a long-term, income-generating portfolio. But remember, since these distributions are taxed differently, it's wise to consult a tax advisor to see if an LP structure fits well within your tax situation. So, what's next for Enterprise Products Partners? The company is in a strong position to capitalize on growing demand for energy infrastructure, especially as the U.S. continues to increase production of natural gas and crude oil. EPD's extensive pipeline network, storage facilities, and export terminals make it well positioned to transport and process these resources, which gives it a major advantage as global energy demand rises. Additionally, EPD has started diversifying into renewable energy sources, exploring ways to adapt its infrastructure to serve cleaner energy markets. This means that the company isn't just relying on fossil fuels for growth but is also positioning itself to participate in the renewable energy transition. Over the next few years, if EPD continues expanding its infrastructure and diversifying its energy sources, it could capture even more market share and provide additional stability for its investors. So, is Enterprise Products Partners a no-brainer buy right now? EPD certainly has a lot to offer: strong financial health, a consistent and high dividend yield, and a solid strategy for the future. However, as with any investment, there are risks to consider, including its reliance on fossil fuels and potential regulatory changes around energy infrastructure. But if you're looking for steady income and a company with a track record of stability in the energy sector, EPD could be worth a closer look. Let us know what you think in the comments below. If you found this breakdown helpful, check out one of the other videos on the screen for more stock insights. Thanks for watching, and I'll see you in the next video.